Welcome to Thank God It's Friday. We're heading into an important event, that is the Jackson Hole Symposium, where we will have global central bankers like Janet Yellen and Mario Draghi, who will be addressing the conference, and of course markets will be closely watching their comments. To take this discussion forward, we're being joined by Jan Dehn, the head of research at Ashmore Investment Management Limited. Thank you for joining us, Jan. Jan, could this be a forum that Janet Yellen actually uses to signal the timeline for the Fed balance sheet unwinding, or is the market seeming unduly worried?
No, I don't think we should expect any major pivotal announcements. I think it's more likely that they will be using this as a forum for discussing their internal uncertainties about the outlook. It's really a big debate right now about whether we're going to continue to have softer inflation, and if not, whether we should go for rate hikes or balance sheet reduction. And I think the question marks still hang over these issues, and I don't think we should expect a major decisive change in the outlook based on what happens in Jackson Hole. I think they need more time in order to be sure that markets that the economy is moving one way or the other before they take a strong directional stance.
Yeah, it's also becoming of increasing concern that inflation across the world, and not just in US, is falling short of its targets despite a healthy growth and fall in the unemployment rate. What could be the implication of this for the policies of central banks?
Yes, that's an excellent question. There are two, as we approach full employment, there are two central concerns of central bankers. One is inflation, as you correctly point out, and that does not appear to be a major problem for right now. And that suggests to me that interest rate increases become less likely than what is currently priced into the market. So on the inflation side, I would say that's the main implication. But of course, on the other side, we also have pumped an enormous amount of liquidity into the financial markets, and asset prices are extremely elevated. And you can argue that even though inflation is very low, asset prices are at bubble levels. Even Fed officials have indicated that much. And that suggests that, to me at least, that if we are going to see any monetary policy action, it is more likely to be focused on beginning the gradual reduction in the balance sheet rather than raising interest rates.
Okay. Jan, how are you reading the Trump administration's impact on the US economy, and what does that mean for fund flows in emerging markets?
Trump's performance has been dismal. The market bought into the idea that he was going to make material changes to the US economy with lots of structural reforms, taking into account that he controls both the houses of Congress. But of course, he's not been able to deliver anything. He's not been able to deliver the border adjustment tax, and particularly he's not been able to repeal Obamacare. And this means that there is very little room for fiscal stimulus, and that in turn suggests to me that we're going to have very soft growth, very small impetus to inflation, and therefore very few rate hikes. And in that environment, with relatively soft US growth and relatively few rate hikes, I think the dollar looks too expensive. So the main implication here is that the dollar is going to continue to decline. And that, of course, is generally pretty positive for emerging markets, where you are now going to get currency upside versus the US dollar, in addition to higher yields and higher equity market returns. So the implication for emerging markets of the failure of the Trump administration so far to implement major fiscal stimulus is that we are going to see a continued rally in emerging market assets.
Well, Jan, shifting focus to India specifically, what we've also noticed is that fund flows in equity markets have tapered. And while fund flows in India's debt markets were strong until the last month, we are looking at some amount of contraction there as well. What do you think is causing this?
I think the very near-term fluctuations and flows should not give rise to too much concern. It's important to remember that we are still in the holiday season in the Western financial markets, and small events can have very big repercussions in terms of market price action. And there's actually a lot of the major institutions are not really putting money to work here. They're sitting on the sidelines. So the short-term volatility is not a source of greater concern. More broadly speaking, I do think that Indian equities look a bit expensive relative to Indian fixed income. And I think the currency backdrop for India is okay. So I think bonds do look a little bit more attractive than equities right now. And that may be explaining why within that volatility you're seeing greater interest in the bond side than in the equity side. Of course, I should make the point that India still has very significant barriers to entry for foreign investors into the fixed income markets, whereas such barriers do not really exist in equities. So to the extent that investors want fixed income more than equities, then you should expect that overall flows into India will decline simply because India's government itself limits how much we can invest in Indian bonds.
All right, so Jan, if the Indian government does lift the curbs on foreign investment in Indian government debt, you would definitely be looking to invest a lot more?
Oh yeah, we certainly would, and not only us. India, given the very large size of its domestic bond market, in fact, it's the second largest bond market in the whole of EM, would immediately be given a weight of at least 10% in the main bond market indices for local bond markets. And all the investors in the world that are benchmark investors would, at least on average, adopt a 10% weight for India. And I imagine many of them would have an overweight. So you should expect to see a very, very large amount of money flowing into India. That would strengthen the currency, that would put downward pressure of inflation, and it would enable the RBI to cut interest rates, which of course would help to stimulate Indian growth. It would be very, very good for the Indian economy. And one of the big questions many foreign investors like myself have been asking for many years is that what exactly are the special interest groups that are preventing India from making this obvious and logical step?
Jan, so, I just wanted to understand what your position or view on the Central Bank of India, that's the Reserve Bank of India's monetary cycle, monetary cycle easing, and whether it's come to an end or it's just that the RBI is likely to take a long pause before they go ahead with another rate cut. Just your view on where the monetary policy is, and of course on the back of that, where are you positioned as far as Indian debt is concerned, more on the shorter tenure or the longer tenures?
Yeah, we're more on the longer tenure, and our view is that the RBI is not going to be cutting very much, if at all. And the primary reason for this view is that we have seen a deterioration in fiscal policy in India. Recently, and that is always a red flag, and it should be a red flag for the RBI. If you go back not so far into the past, we have seen that traditionally loosening of fiscal policy and excessive reliance on fiscal stimulus has really been the root to all evil, so to speak, for Indian investors. And so whenever fiscal policy gets a little bit too loose, the RBI needs to be very vigilant and be ready to not cut rates. I think that's quite important. My impression of the RBI is that it is quite a vigilant central bank. It is quite a prudent central bank. So that would bias me towards a view that we're not going to get maybe as many rate cuts as the market is expecting.
All right, Jan. So from a foreign investor point of view, we saw demonetization last year. This year around, we also seen a big tax overhaul with GST coming in. Do you have the opinion that reforms in the near term will take a backseat for this current government because they would start preparing for re-election in 2019?
Yes, that would have been my base case. But of course, we had a recent local election in India, which went very much in favor of the government. And that suggests that the government has somewhat more political capital than perhaps people were expecting just a few months ago. So all else even, that suggests that that there is a small possibility that further reforms will take place. I think by far the most important reform that should be done right now, that GST and demonetization's out of the way, would be to finally focus properly on the capitalization of public sector banks. This may be one of the genuine reasons for not opening the bond market, because foreign investors in the bond market would require properly well-capitalized and solvent public sector banks as market makers and so on. So I think it would be wise for the government to speed up its reform of the public sector banking system. A healthy banking system is absolutely key to getting the credit cycle going and therefore to sustain the pace of growth. So to the extent that Modi's political capital is a little bit higher than maybe expected at this point in the cycle, there is a small possibility that they will make progress in this area. But in general, I would expect that the pace of reform should slow down as we head into the next political season.
All right. So on the back of that thesis then, Jan, what have you done with your Indian portfolio holdings over the last 1 or 2 months? Of course, you've spoken about how the debt markets in India look attractive. What have you done with your equities portfolio?
Yeah, our equity portfolios, we've been a little bit more cautious. We do think the valuations are very high in absolute terms, but also relative to valuations you get in other markets. So we're becoming a little bit more selective, focusing more on genuine value propositions, and scaling back a little bit of our exposure in the cyclical stocks.
Jan, you do have a marginal exposure to Indian banking stocks like Axis Bank and HDFC Bank under the Ashmore Emerging Markets Active Equity Fund. So what's your view on Indian banking overall? Because many of these banks are staring at multi-year low credit growth and are ridden with stressed assets.
Yeah, I think it is very important to be very selective in Indian banks. There's considerable weakness in a number of Indian banks, but there are others that offer good value, and you need to be quite selective where you go in. The fact that credit growth is relatively low is ultimately a good starting point. I think there is room for some banks to increase their market share and to broaden their activities in financing the private sector. But the banking sector as a whole is still being held back by the vulnerabilities of parts of the public sector banking system.
Jan Dehn, thank you very much for your time. It was a pleasure speaking with you for your perspective. And as for you guys, we see you next week once again on another edition of Thank God It's Friday. Till then, it's goodbye.